Hello and welcome back to Coinscrum Markets. I'm thrilled to be joined by Sid Powell, co-founder and CEO at Maple Finance today. Hi Sid, thanks for joining us.
Hey Paul, thanks for having me. Good to be here.
Good to have you. I hear you're out in New York. Conferences opening up again, so hopefully people are meeting face to face. And I'm sure there's lots of discussion going on. There's been a lot happening over the last year and a half when everyone's been locked up. Nothing more so, I guess, in crypto than the growth of DeFi and the explosion of DeFi. And I guess before that, but in tandem, growth of the lending markets in crypto in general, both centralized providers, centralized lending desks, but also more and more so DeFi platforms providing lending services. Big topic, obviously in the current economic environment, yield is hard to find. So, anything that generates the types of returns that you have been seeing for lending digital assets is probably going to become more and more attractive to institutional players. And I guess one of the big barriers to entry so far, especially for DeFi, is, I guess, grey areas around regulatory requirements that some of the more traditional participants will probably need to fulfill if they're going to enter these markets. And that's something that Maple has sort of taken on board from the beginning, and as part of their very core design of the platform, to be able to start, reaching that market in terms of institutional investors and offering some of those opportunities. So should we just start by, if you can just give us a little bit of your background, what you were doing before you started working on Maple, and then we can just dive in and find a little bit more about the platform and how it works.
Yeah, absolutely. So prior to Maple, I was working in debt capital markets. So I would help corporates to raise debt so that they could reinvest in expanding their businesses. I then led treasury at a commercial lending company. And it was during that time I started thinking about how we could harness the transformative power of blockchain to connect global capital with the areas that it would, where it could have the most opportunity.
Okay. So with Maple specifically, I mean, some of our audience are probably quite familiar with DeFi and how these decentralized exchanges and lending platforms work. Not everyone. As I've said before on this show, in many ways, we're reinventing what exists in traditional markets, but in many ways also democratizing it. And a lot of functions which have previously been performed by central intermediaries are now being kind of encoded into smart contracts. So can you just talk us through what it is you've developed and on a high level, what the different components are and who the different participants are within the system?
Yeah, for sure. So the way I would characterize Maple is that it is an institutional capital marketplace built on top of Ethereum. So on the one side, we provide under collateralized loans to crypto native companies who would use those to reinvest in expanding their businesses. And then on the other side of that marketplace is a lending opportunity for holders of stablecoins who wish to deposit them into Maple pools. So that's at a high level how I would characterize it overall. And then there's three participants on Maple. You have the lenders, who are typically institutions who want to earn a yield on their stablecoins, so they deposit them into a Maple pool and they're lent out. You have the delegate, who acts as kind of a manager of that pool. So what they do is they perform the due diligence and underwriting assessment on a borrower, and then approve the loan terms to them. But they never custody the funds. And then you have the borrowers, who are crypto native institutions. Typically we're serving market makers, market neutral funds, and they are borrowing to expand their businesses. In future, I would see that expanding to include other companies within the crypto native space. This could be miners, could also be SaaS companies in future.
Sure. Okay. So up until now, DeFi platforms, I mean, it really has been completely open to anyone, which I guess some people see as a positive development. But as we've already mentioned, the reality is that to attract a larger and more institutional type audience, there's going to need to be some checks and balances, and that's clearly what you're building in from the start. In doing so, though, there needs to be some, I guess, level of human touch point or some human touch points here. So compared to those fully open platforms, what is it that you bring to play, and how do you manage those onboarding processes to give all the participants satisfaction that their kind of responsibilities from a compliance perspective have been met?
Yeah, so the way that Maple's worked from the beginning is that it's providing credit creation on the borrower side. So it's always been really important to know who the borrowers are. And so when we're dealing with institutional participants who take out loans on Maple, they would go through a KYC process to begin with. That's relatively standard and well trodden, but then they also importantly go through a pretty rigorous due diligence process with the pool delegates on the platform. And this would involve a call to discuss the way that they operate, use of funds, financials, management's experience and track record, so that the delegate can get comfortable that the loan is going to be repaid. And then increasingly on the other side, we're seeing appetite for institutional, what you might call permissioned pools. And so that with future pools there, we have the ability to turn on whitelisting if required, and that might follow a similar process because certain institutions, they already have existing relationships and they prefer to deal with those relationships and now see a good opportunity to bring those into on-chain infrastructure.
Yeah. Well, that makes a lot of sense. And one of the things that you offer, and I guess this is probably more comparable to the centralized lending desk that we mentioned, which oftentimes come with a white glove service and go through a similar level of due diligence to understand their counterparties and any risks related to them. So you're offering under collateralized lending. How do you manage any risk in terms of during market volatility and potential margin calls that will be required?
Yeah, so there's a few ways that we manage the credit risk there, which is what you're alluding to. The first of these is focusing on high quality counterparties. So we're typically dealing with the largest, the largest market makers and funds in the space. Known borrowers on the Maple platform today include Alameda Research, Amber Group, Wintermute, Folkvang, Nibio. So these are very high quality counterparties. They go through a due diligence process, as I mentioned, where their financials would be assessed. Then to give lenders further comfort around how risk is managed, pools are diversified. So you're not lending to one party in particular. You actually have a pro rata share of every lender in the pool. And then we're really big on transparency. And I think this is one of the key areas where we might differ from CeFi yield opportunities, where you don't necessarily know who's borrowing on the other side. And that is that anyone who goes onto the Maple platform and looks at one of the pools will be able to see all of the borrowers who are in that pool and therefore the source of that yield. So I think that's been particularly important. And then the final way in which risk is managed is that the delegate needs to put skin in the game. So I think that's another element that's really important. So you can see that they would be staking to a subordinated reserve in that pool, and that offers just a bit of extra credit enhancement for the lenders who are senior in that pool.
Right. Okay. And you, like many of these platforms, you do have your own token. Can you just explain what that's there for, and what benefits people get from holding that token?
Yeah, for sure. So Maple has a governance token. It's MPL, and this token is used for governance decisions. Like we recently had a vote on changing some of the fee settings, for example. The other key purpose that Maple serves is for allocation of risk, and that gets to that staking reserve that I talked about. So a pool delegate would be required to stake both Maple tokens and USDC, so stablecoins, into that reserve. And that means that the reserve is effectively denominated in both Maple tokens and stablecoins. And what it does then is it receives a portion of the fees that go to that reserve. So by default, that's about 1/10 of the interest yield coming through the pool, but it just ensures that Maple is required as a utility token to participate in supporting those pools.
Right. Okay. Understood. That will make sense. So you've obviously clearly mentioned that you're supporting stable coins now. It does seem that stable coins are definitely getting the attention of institutional participants in various ways, whether it's yield generation or just the ability to settle non-banking hours over the weekend when they're accessing the crypto market. So I think we can all assume, especially with the work that a lot of central banks are doing, that stable coins are kind of going to be here to stay and bring a lot of efficiencies into multiple markets. What's the plan longer term? Is it you specifically going to be focusing on stable coins, or are you going to be gradually kind of bringing in other tokens? And obviously that brings around different kind of risk exposure for participants, but that's something they could potentially manage. What's the plans going forward?
Yeah, I think first of all, I would say the market for stablecoins can get much, much larger than what it is today. And so that will probably be the core center of gravity of the platform. And I think there's a couple of really important things to note about stablecoins. It's effectively like it's like a 5% export subsidy, right? For sort of any companies or industries within the US. And so I think that's why there's going to be such a terrific tailwind behind it. By not having to go through the conventional SWIFT system and T+3, you actually make US companies a lot more competitive in exporting their services internationally. So I think core will definitely be stablecoins for some time, but we are looking at supporting other tokens, and we see appetite on the market making side for some of the altcoins out there. And so I think we do have plans to introduce probably a handful of these to test the waters there and size up the market over the next few months.
Okay. And are you just covering fiat-backed stablecoins such as USDC, or are you looking at programmatic ones such as Maker?
At the moment, we're just covering the fiat-backed ones. So we've really gone by kind of market capitalization. So we support USDC, have seen a lot of appetite there. We also see inbound interest for Tether, for example. And so so we're exploring the ways that we can best serve the borrower's appetite and also the lender's appetite.
Okay. And you mentioned your kind of early adopters, which are large players entrenched in liquidity provision within the crypto ecosystem already. Everyone uses this term institutional. We all know that's kind of a broad spectrum, and it's maybe a ladder that you have to go one rung at a time on. So what's the reality when you're going out there speaking to guys at more traditional funds that might be interested in these opportunities, quite enticing yields? We assume that the majority of them are or have been doing their homework on this space now. So what's the typical conversation like, and how many people are ready to actually move in?
So in terms of readiness, it varies institution to institution, but I think what's really attracted a lot of them here is that this is a product they can understand because it's more of a yield product on the lending side, and so they don't have to necessarily be red-pilled that certain crypto assets are going to be much larger in future. Instead, what they see is they're already comfortable with kind of stable coins, and what they see is an opportunity here to get a yield on those stable coins that is far better comparably to what they can get in traditional markets. And they like the fact that there is capital preservation within capital preservation in those yields. So this is ultimately a fixed income product, and then they can see transparency in the way that the platform is set up. I mentioned how information on those borrowers is shared, and the performance occurs in real time. So it's something that's less of a bridge for them to cross than certain other products in the space, and we find that helps conversations. Yeah, definitely.
And rules generally in most jurisdictions around KYC and AML are pretty clear. And if we're leaving aside some of the more speculative crypto tokens at the moment as well. Has that made the process relatively easy for you to follow and get this live and tick the boxes to be able to onboard these companies, or are there still obviously certain question marks that might remain that they're not quite comfortable with yet?
I would say it's an evolving process. So certainly in terms of the use of the funds on the platform, they're all going to KYC'd borrowers, and I think that was always inherently important just because of risk management. You want to know who the institutions are. who are borrowing and ensure that they are able to repay those loans.
Mm-hmm.
Increasingly, we're seeing more appetite for KYC participation on the other side of the marketplace. We've built in the ability to do whitelisting, so that can be toggled on. And I would say what's one thing that will certainly help is better KYC user experiences. I would say the user experience of it is typically very manual, and that's something that that would definitely be welcome in the space.
Yeah. I mean, if we think about other markets that might benefit from this, I guess, there's a huge market in securities lending, and that's been, tokenized securities has been bubbling away beneath the surface for the last few years. I think a lot of those platforms and projects that were kind of early to the game found that, I guess it's the challenges for them were around lack of regulatory cohesion, with different jurisdictions having different requirements around the securities laws. Do you see that as a market that you'll be able to go after at some point?
Potentially in future. I mean, the way that I would characterize Maple is really its infrastructure for lending, and so whether the assets that are pooled and lent are native crypto assets, or could in future include tokenized versions of kind of real world assets, is kind of to be determined by the participants on the platform. We will respond with going where the greatest need is. And I think that's probably one of the mistakes that a lot of participants who were early to that game made, was that they actually focused on, here's a huge addressable market rather than here's a burning need. And they built something for people who weren't yet actually ready to take the ticket to the show.
Yeah, no, that does make a lot of sense. And I think we've seen that play out before. Timing is everything with innovation. So I mentioned earlier that, and I guess you see this as a good thing for the industry in general, that the likes of Aave and Compounder are launching their own KYC liquidity pools. How's the industry working together? Because I think, is at this stage of the industry, co-opetition is probably best. Stronger together is probably best. What are you seeing or sensing from people in terms of looking to work together, to develop standards, to bring broader comfort, and hopefully the case that you all win together?
I think one of the great things about the space is the composability, which I think is probably a byword for collaboration within the space. So, we've been at some of the conferences this week and last week in New York, and it's been great to see all of the proposed collaboration between different protocols, and also people who are more on the centralized side, say funds and investors in the space. So I think broad industry standards would help, and this is one of the advantages of kind of composable products, is that, let's say you could have a movable identity type product, or tokenized identity, that can be ported into different Web3 apps. Certainly something like that would not be the domain of us or a single other lending protocol like a Compounder or Aave, but it would be something which allows us to work closer together, and is a bit of a bridge or an enabler in the space. So I think that's terrific. And then so probably one of the key ones is, I guess, standards around identity and use between protocols.
Yeah, no, I think so. I mean, I've been banging on that identity will be the thing that brings all of this together at some point. I know there's a lot of work going on there. There's even consultations at W3C at the moment about open standards and standardization. So hopefully that's something that we will still see filter through over the coming years. I think that's going to be a big theme. What about other things? I mean, you said you've built on top of Ethereum, question marks about scalability for all of this. Do you foresee any near-term scalability issues that might impact you? I'm guessing that the type of users that you've got, fees, although might be painful, probably, the type of tickets that they're dealing in might be less of an issue right now. Are you planning to support other networks? And have you discovered any issues around scalability that you kind of need addressing by developers elsewhere before you can move?
Good question. So I think, as you alluded to at the start of that question, the ticket sizes that are generally done on the platform, so 80% of depositors are sort of over $1 million in size. All of the loans are generally over $1 million in size, and I would say the average loan size is probably in the 3 to 6 mil range. So generally, when you're dealing with transactions those size, gas fees are not an issue for the user. I would say where it does come into play though is obviously faster transaction speeds just creates a better user experience, and so we would look at. We haven't committed any one way yet because we found we have enough to build on layer one in the meantime and improvements to make there. But as we look out ahead, some of the things I am excited about, I do like Arbitrum and Polygon as scaling solutions. And then as I look cross-chain, I see chains like Solana as being potentially quite attractive because of the trader base that it attracts, which is sort of naturally aligned with our user base, as well as potentially chains like Avalanche and Algorand, because they typically might have a more institutional user base, and so I see opportunity there. What would drive us to go to one chain perhaps first is really an assessment that there is an opportunity that is not going to cannibalize our existing user base, but is actually going to complement what we already have, whether it be on the lender side or whether it be on the borrower side.
Yeah, okay, that all makes a lot of sense. So what is on your roadmap? What's your most pressing issues going forward, and what can users expect to see coming down the pipeline?
So within the next few weeks, we will actually have a reskinned web app coming out, which I think is going to hugely improve upon what we've had in place to begin with. So really excited about what the team's bringing out there. So we have our UX designer and product manager working on that. But I think the team is also hard at work designing what will be our V2 of our smart contract protocol, and this is going to be set up to be far more composable, so that we are future-proofing ourselves and offering the ability to develop in real time new lending products to suit different use cases. And then the other thing is, the team is on the road meeting some of our institutional participants, and this has been our biggest focus for now, is just building the awareness of how risk is managed, so that we can build trust with them and onboard more users, so that we can grow the TVL on the platform. So from a standing start in May, we had an initial pool of 17 million. We've now hit about 172 million 3.5 months later, and we're looking at how we can grow that to north of 500 over the next couple of months.
Excellent, sounds very good. And what's your vision or view around opening up access to the platform for other people to build on top of once you gain more traction?
Yeah, I think a few of the things I'm excited about, which I think I see as natural integrations with the platform, would be things like we talked about identity and credit scoring before. So I think ratings are something that obviously is huge in debt markets, and so there are a few projects that are doing exciting things there. I think we're very close with the team from Xmargin. I think they've built a great zero knowledge score that's particularly attractive to and applicable to our user base, being traders. And then we also have, I was caught up with the Teller team earlier in the week as well, and I think what they're doing with both on-chain and off-chain scoring is tremendously exciting as well. The other thing is, I know teams like working in the interest rate space, and so I think the ability to fix or swap interest rates built on top of the platform is also very interesting.
Yeah, I think there is a lot of interesting stuff coming down the line, which will tie all of this together. So just to finish off, going forward, the markets have been strong. There's been so much interest now. I mean, I'm guessing anyone that has any intention of potentially entering this space is aware of it now, and I think you'll probably agree that people are far more educated than they were even maybe 12 to 18 months ago. So a lot of your time is saved in meetings having to kind of explain the most basic stuff. How realistically, over a 5-year time frame, how big can these markets get? I mean, obviously debt markets are huge in traditional markets. How much of that pie can like DeFi eat?
I could give a really eye-popping number there and say hundreds of billions, because I think naturally in future, so In the shorter term, adoption is probably going to be slower than what we recognize, just because those conversations do take longer internally. So let's say within 2 years, it'll probably be smaller than what I would estimate, but within 7 years or 5 to 7 years, it's probably going to be multiples of what I would actually estimate. And so I think the market truly is in the hundreds of billions in that 5-year range, if not trillions. And the reason for that is a couple of elements. So I'd say it's going to seem as silly going through kind of traditional debt markets in 5 years as it would, trying to send paper mail across the Atlantic Ocean. It's just the same step function as email. And then the other element is that what DeFi does is actually dramatically expand the market. So it's similar to the impact of the Sony Walkman had on music consumption versus, say, having a speaker in your house. And a radio. It massively expands the market to include effectively everyone who's been in the kind of the US private debt markets now, because it's been too expensive to be served by traditional investment banks.
Yeah, no, it is interesting, and we'll have to wait to see exactly how it turns out. But I think the possibilities are endless. So congratulations to you and your team for getting the platform to this stage. Great to hear about how it's progressed so far. We'll certainly be keeping an eye on future developments. Thanks for joining us, Sid, and hopefully we'll get you back at some time soon.
Terrific. Thanks, Paul. Really enjoyed it.
Cheers.